What happens when a dying movie theater chain becomes a $30 billion phenomenon overnight, then nearly loses it all to crushing debt? In early 2021, AMC was literally weeks away from bankruptcy. Empty theaters, crushing debt, and streaming services taking over. Then, something absolutely unprecedented happened. An army of internet traders decided to intervene. AMC's stock exploded, and a company on life support was valued higher than most Fortune 500 companies. The internet had just attempted the ultimate corporate rescue. But when the dust settled and the memes died down, one question remained. Could viral momentum actually solve AMC's problems? Today, we're exploring one of the most unbelievable Wall Street stories of the decade, and what happened when social media met old-school economics. AMC's story goes back to 1920, when the Dubinsky brothers opened a single movie theater in Kansas City, Missouri. They originally named it Durwood Theaters, but eventually rebranded it to American Multi-Cinema, or AMC for short. For decades, AMC was your typical theater chain, but in 1962, they revolutionized the industry when Stanley Durwood, one of the founders' sons, opened the world's first multiplex theater in Kansas City. Instead of just one screen, this theater had two screens under one roof, an idea that seems pretty standard now, but was a game changer back then. This was just the start of AMC's trailblazing ways. In the 80s, they went public for the first time, using the funds to expand across the US. In 1995, they rolled out the Megaplex concept with AMC Grand 24 in Dallas, boasting stadium seating and an impressive 24 screens. In the early 2000s, they experimented with premium formats, luxury recliners, and upgraded their food options beyond just popcorn and soda. For almost a century, AMC has adapted and evolved, riding the waves of change in American entertainment. But the company's biggest challenges and most dramatic chapters were still to come. AMC's modern story began in 2012, when the Chinese giant Dalian Wanda Group bought the company for $2.6 billion. This deal set the stage for a bold expansion plan that would fundamentally change AMC's financial structure. Under Wanda's ambitious leadership, AMC launched an aggressive global expansion campaign. In 2016 alone, they bought three big companies: Carmike Cinemas for $1.1 billion, Odeon and UCI Cinemas Group for $1.2 billion, and Nordic Cinema Group for $929 million. These bold strategic acquisitions catapulted AMC to become the world's dominant theater empire, boasting over 11,000 screens worldwide. But this rapid growth came with a serious price tag. To fund these acquisitions, AMC racked up a ton of debt. By the end of 2016, their long-term debt had ballooned to over $4.2 billion, a jaw-dropping number that would loom large over AMC's future. In 2018, Silver Lake Partners, a private equity firm, invested $600 million into AMC. But it didn't really change the debt situation. Instead, it reconfigured the ownership status, with Wanda still holding the voting power through a dual-class share arrangement, or a system that is both regular shares that anyone can buy with normal voting power and super shares that Wanda kept hold of. These have way more votes per share, letting them stay in control. Adam Aron, who stepped in as CEO in 2016, defended this strategy as necessary for growth. Scale matters in our business, he often told investors, and for a while, it looked like he might be onto something. AMC's revenue climbed steadily, hitting $5.47 billion in 2019. The company was making money, though the margins were pretty slim. But behind this seemingly good news was a weakness. AMC had become a highly leveraged company in an industry already getting disrupted by streaming services. Any significant shock to its business model could be disastrous, and that shock was just around the corner. When the devastating COVID-19 pandemic struck in early 2020, AMC's theaters worldwide were forced into immediate closure. Almost overnight, the company's revenue stream dried up completely, and they still had a mountain of debt to service. The financial devastation was absolutely staggering. In the second quarter of 2020, AMC's revenue dropped by 98.7% compared to the year before, going from $1.5 billion to just $18.9 million. They reported a net loss of $561 million for that quarter alone. By the end of 2020, AMC had racked up over $4.6 billion in losses for the year. Cash was being burned at an alarming rate. It cost around $125 million a month just to keep the closed theaters running. With $5.5 billion in debt and dwindling cash reserves, AMC was staring down bankruptcy. In October 2020, the company warned investors it might run out of cash by the end of the year. Adam Aron didn't sugarcoat it, telling CNBC, "We're burning through cash." The company tried everything to stay afloat. They furloughed almost all of their 35,000 employees, including Aron himself. They worked with landlords to push back rent payments and paused dividend payments to shareholders. But it still wasn't enough. By December 2020, AMC was on the verge of filing for Chapter 11 bankruptcy protection. Then, something incredible happened, something no financial expert saw coming. In January 2021, a passionate army of retail investors on Reddit's explosive Wall Street Bets forum launched an unprecedented assault on heavily shorted stocks. Basically, companies that big investors were betting would fail. GameStop was the first one they went after, but AMC quickly became the second. The idea was pretty straightforward. If enough small investors bought up these stocks and held onto them, they could spark a short squeeze, making those big investors buy shares at inflated prices to cover their bets. It was a classic underdog story that really hit home during a time of growing wealth inequality. AMC had everything going for it. It was a nostalgic brand that people had strong feelings for. Hedge funds had heavily shorted it. Plus, its stock was dirt cheap, trading under $2 a share. So even smaller investors could buy a decent amount. In a breathtaking surge, AMC's stock rocketed skyward, exploding from $2 to $5, then catapulting to $10, and thundering past $20. Trading volume went through the roof, with billions of shares changing hands. Online communities rallied around the hashtag #SaveAMC, and a new term popped up, Diamond Hands, which referred to investors who held onto their shares despite all the ups and downs. By June 2021, AMC's stock hit an insane $72.62, an incredible 3,600% jump from its January lows. The company's market cap briefly went over $1 billion, even though its theaters were running at reduced capacity and it was still in a lot of debt. Adam Aron, unlike most CEOs, embraced this new group of investors. He started calling them apes, adopting their own terminology, and connected directly with them on Twitter. He rolled out perks for shareholders like free popcorn and special screenings. He even started taking questions from retail investors during earnings calls, which is almost unheard of in corporate America. Most importantly, Aron used this stock price rise to help AMC. The company issued millions of new shares, raising over $1.8 billion in fresh cash. This money pulled AMC back from the edge of bankruptcy and gave it some breathing room to deal with the ongoing pandemic. But it didn't last. The meme stock phenomenon proved to be AMC's financial lifeline, though it brought new strategic challenges. On one hand, it gave the company the cash it really needed at a crucial time. Without that stock surge and the money raised from selling shares, AMC would probably have gone bankrupt. However, the dramatic gap between AMC's market valuation and operational fundamentals presented complex strategic considerations that management would need to navigate carefully. The market seemed to think AMC was worth more than rivals like Cinemark, even though they had similar revenue and way more debt. While the stock sales were essential for survival, they also diluted the ownership for existing shareholders. The number of AMC shares jumped from around 104 million in early 2020 to over 500 million by mid-2021. That meant each share now represented a much smaller piece of the pie. Wall Street analysts didn't hold back in their criticism. Rich Greenfield from Lightshed Partners set a price target of just 1 cent for AMC stock in early 2021, calling it dramatically overvalued and saying bankruptcy was still on the table, even after raising capital. But the biggest hurdle was still AMC's basic business model. Even with the pandemic easing up, the company was stuck with the same issues it had been facing for years: streaming competition, fewer people going to theaters, and that huge pile of debt. Despite raising $1.8 billion, AMC's debt problem hadn't gone anywhere. By the end of 2021, they still had over $5 billion in long-term debt, with annual interest costs over $400 million. This debt wasn't just a number on paper. It severely limited AMC's ability to invest in its future. Every dollar spent on interest was a dollar that couldn't be used to improve theaters, add new features, or keep up with what customers wanted. AMC's 2021 annual report made the situation clear. Our substantial level of indebtedness and our current liquidity constraints could adversely affect our financial condition and our ability to service our indebtedness, to prepay debt, and to refinance debt, and to do so on favorable terms, and our ability to take advantage of certain business opportunities, which could negatively impact the ability of investors to recover their investment. In 2022 and 2023, AMC made some progress in tackling its debt. The company managed to refinance some loans, extending payment deadlines and slightly reducing its interest costs. But these were just small steps, not big changes. By mid-2024, AMC's long-term debt was still over $4 billion. They had been able to push most of their payment deadlines past 2026, giving them a little more space to breathe, but the main issue was still there. They had to figure out how to make enough cash to pay down this debt while also investing in the business. Aside from its money troubles, AMC had an even bigger issue. Streaming services were changing how people enjoyed entertainment. Netflix, Disney+, HBO Max, now just Max, and other streaming giants were investing billions in premium original content that viewers could enjoy from their couches. The pandemic sped this up, with many studios trying out same-day streaming and theater releases or cutting down the usual theater run. AMC refused to surrender and instead fought back with innovative strategies and bold initiatives. The company struck new deals with studios to keep some level of exclusivity, usually around 45 days instead of the usual 90. Aaron, the CEO, was outspoken about how important the theater experience is, insisting that streaming and theaters could coexist instead of being in a constant battle. There were some encouraging signs that backed this idea up. Once theaters fully reopened, big hits like Spider-Man: No Way Home, Top Gun: Maverick, and Barbie showed that people would still head to the theater in droves for the right movies. And to give AMC some credit, the company didn't just roll over in the face of these challenges. They started a bunch of initiatives designed to diversify its revenue streams and make the theater experience even better. One major move was investing in premium formats. AMC put a lot of money into IMAX, Dolby Cinema, and their own Prime screens, offering experiences you just can't get at home. These premium formats came with higher ticket prices and lured in movie lovers looking for something special beyond streaming. They also focused more on food and drinks, expanding their dine-in theater concept and adding full bars to many locations. By 2023, food and beverage sales made up over 35% of AMC's total revenue, with significantly higher profit margins than ticket sales. And maybe the best thing they did was launch their own subscription service, AMC Stubs A-List, in response to the briefly popular MoviePass. You can find out more about that in another one of my videos. For $19.95 to $24.95 a month, depending on where you live, subscribers could watch up to 3 movies a week. Unlike MoviePass, which fell apart because of its crazy pricing, AMC made sure their program was financially smart. As of mid-2025, AMC has successfully navigated its most challenging period and now operates from a significantly strengthened position. The immediate threat of bankruptcy has passed, thanks to the capital raised during the meme stock frenzy. But the company's long-term challenges remain formidable. Financially, AMC is showing signs of improvement. In Q2 2025, the company predicted revenue of $1.398 billion, a 35.6% increase from the same period in 2024. Its net loss narrowed to just $4.7 million, compared to $32.8 million a year earlier. These impressive figures demonstrate a resilient business that has not only recovered from the pandemic's impact, but is building momentum for sustained growth. However, AMC's debt burden continues to weigh heavily. Despite successful efforts to extend maturities and reduce near-term obligations, the company still carries over $4 billion in long-term debt. Annual interest expenses consume a significant portion of its operating income, limiting its ability to invest in growth initiatives. The stock price tells its own story. After peaking at over $72 in June 2021, AMC shares have gradually declined, trading around $3 to $5 in 2025. This represents a significant premium over the company's pre-pandemic valuation, but is a far cry from the meme stock mania days. Operationally, AMC continues to adapt to changing consumer preferences. The company now operates 898 theaters, with 10,059 screens worldwide, a slightly smaller footprint than before the pandemic as it has closed underperforming locations. Its focus has shifted toward premium experiences, with an increasing percentage of screens offering enhanced formats, luxury seating, and expanded food and beverage options. The AMC transformation offers powerful and inspiring business lessons that resonate far beyond the movie theater industry. First, it demonstrates both the power and limitations of financial engineering. AMC's big buying spree made it the largest theater chain in the world, but it also piled on a ton of debt. When things went south, that debt almost took them down. Second, the whole meme stock phenomenon shook up the capital markets. For the first time, retail investors organized through social media showed they could sway stock prices and corporate outcomes. AMC would likely have filed for bankruptcy without the capital raised during this period. This means traditional financial models need to account for the unpredictable influence of retail investor sentiment in the social media age. Third, AMC's journey highlights how crucial it is to adapt when faced with tech changes. The rise of streaming posed a serious threat to traditional theaters. Instead of fighting it, AMC has been trying to evolve its business, focusing on premium experiences that streaming can't offer. Finally, AMC's story demonstrates the tricky balance between financial goals and emotional connections. Movie theaters are a big part of American culture. They're not just places to watch films, but arenas where memories are made. This emotional connection helped spark the #SaveAMC movement and continues to shape the company's choices. As for AMC's future, that's still a work in progress. The company has made it through its toughest times, but major challenges lie ahead. Can it keep cutting down its debt while investing in new innovations? Will theaters still be relevant in a world that's becoming more digital? What's clear is that AMC's story isn't over yet. 100 years after the Dubinsky brothers opened their first theater in Kansas City, the company they started is still adapting and evolving. AMC's path to sustained success in this new era lies in its proven ability to masterfully balance financial discipline with groundbreaking innovation. Wall Street loves hype until reality sets in. Subscribe for more deep dives into the companies that soared, stumbled, and collapsed like this video, where another cinema giant, MoviePass, went from shocking rise to finding a way to lose $73 million a month.